Sure. All right. So here is 12.2. Talking about some payroll. Okay. So when we're dealing and working and with pay, the first thing we got to do is figure out how many hours they worked. If they're an hourly employee, we just went over 12.1. I just put the videos up. So if you wanted to look at them, you can. Okay. And I got some sheets I'll give you. So now we have these tax sheets. I'm not where you're supposed to be. Sorry. Okay. Payroll tax. All right. So when first thing we do is we got to figure out how many hours people work. Then the next thing you got to figure out, all right, is those total earnings or gross earnings or, gross pay is all the money before deductions. Now we got to start figuring out how do we do some deductions. We are going to do basic deductions, but it could be helpful for you in, let's say, like a first type job, or you can at least be somewhat knowledgeable on this. You could talk to your parents about it. It'd be interesting for some of you. Obviously, there's different ways of doing taxes. My dad's retired. He gets a bunch of money from all his retirement stuff, so he doesn't give the government anything, and he writes a check at the end. So he always pays a bunch at the end because he'd rather have all his money now, invest it, yada yada yada. When I was younger, starting out, teachers would get, I'm getting old, but I mean, the bare minimum wasn't a lot of money. Now it's it's 20,000 more than it was when I started teaching. But so I always wanted to get as much money as humanly possible. But I couldn't afford to pay a big tax thing in April, right? I couldn't afford it. I didn't have $1,000 in savings because you're living month to month, week to week, type of thing. Now I'm getting to the point where I don't want to pay taxes, but I don't want a refund. So that was kind of the idea. So I'm trying to make as little pay or refund as humanly possible. I want to get it so that I collect and keep as much money of mine as possible without having to pay a bunch. And so it just kind of depends on your theory. You should probably ask your folks and see what they say. But I think it's, there's no real right or wrong answer other than you don't want to have to pay a ton and then you can't pay it later. Like I said, when I was younger, I wasn't great at saving. So I needed to just take as much tax as you can. I can't afford to pay it and so there's different things you can do with these sheets with retirement. And that's what we're going to get at. Okay. All right, so we have some taxes they call payroll taxes. All right. Is payroll tax something that's optional? No. All 50 states, federal income taxes withheld. Okay, you got to pay a certain amount of tax. All right. Employers in some states have to require bigger taxes. It just kind of depends. It varies from state to state. Yada, yada, yada. Okay, the amounts withheld ensure the employees has paid the amount equal to the employee's annual tax liability. Income taxes withheld must be sent periodically to respective government agencies. So you got to pay these taxes that you collect. Okay, so first thing we got to know is taking taxes out is not an option. You got to pay these taxes. There is certain options in certain states. Some states don't require you to pay state tax. You don't have to pay state income tax in like Texas and Florida and one of the Dakotas and maybe New Hampshire or whatever. So that's why you have there's a ton of big time, the 1%ers that live in Florida or Texas because they don't have to pay state tax. But we have to take these taxes out of our checks. All right. So that's just not an option not to. Taxes based on payroll, called these payroll taxes. Makes sense. Okay. All payroll taxes are based on the employee's earnings. Therefore, us as businesses or as employees or employers, you need to understand that these records need to be accurate, need to be done correctly. There was one time in my life where our paycheck got screwed up. It was my 3rd year of teaching. Because all of a sudden we all had way more money. And everybody's like, what the hell happened at the bank? We weren't going to tell anybody because we were hoping to be. And then, of course, they clear it up, obviously. But we got paid, like they forgot to hit a button or do something. We got paid a ton more. I mean, 300, 400, $500 more because it was noticeable to all of us. And it happened across the board the same amount. They did something, they slid over on a table down where they weren't supposed to be, and everybody got more. But basically, all my checks, and I've never really had any issues other than that. And then one time we got paid twice, and they figured it out the second day. Like all of a sudden we looked, and there's like we got paid the exact amount twice. So there's only been 2 goof ups in 20 some years, 22 years. But you need to keep accurate records. Payroll taxes withheld represent liabilities for employers. We've talked about this until they're paid. So if we have a bunch of employees, we take their taxes out, it's seen as a liability until we pay it off. It's not our money. We don't take it, and it's not ours. We got to pay that off. All right. So here's a withholding allowance certificate. Basically, you want to say how many allowances you have, and we'll talk about what that means. It has all your pertinent information. You guys have probably filled out similar tax forms, whether it be a W-2, W-4, they have 52. I mean, there's just a lot of different things going on. But you get the gist of filling out forms like this. This is a withholding, a W-4. All right. Deduction form, total earnings for the legally supported person, taxpayer, including the employee, is called what is a withholding allowance. Okay. Generally speaking, if you look at the chart, the more withholdings, the less tax is taken out. If you look at those charts that we showed you, and we'll get to these other charts in a minute. Okay. So deduction from total earnings from each person legally supported by a taxpayer, the employee, including the employee. So you can count yourself, or you don't have to. You can count 0, and they'll take the most taxes out. You got 4 kids, you can claim a bunch, and they'll take a little more taxes. They'll take, your taxes will be less. It just kind of depends on how you want to do things. Okay. The information used to determine how much income tax be withheld is on the form called the W-4. Okay. Employers require that you got to take a W-4 for each employee. You can change this. I'm pretty sure at Urbandale you can change it any month you want. It doesn't have to be for the entire year. I've never had to, but I'm pretty sure you can change. If your life changes dramatically with a marriage, kids, divorce, something like that, it might be that you can't change it till the next month or something, but you can adjust this accordingly. And then as your income keeps growing and getting bigger, you can change how you want to do things as well. Okay. Income tax withheld is based on the marital status. Okay. If you're single, you got, for whatever reason, you have to pay more taxes, and the number of allowances. Okay. And that's what that sheet is for. We need to be careful when we're looking at those sheets that the married sheet is the one you're looking at, or the single one that's necessary. Don't go off the wrong sheet because you'll get the wrong numbers. Married employee will have less income tax withheld than a single employee with the same earning. The larger number of allowances claimed, as you can see, the more allowances are on the top. As it goes across to like 10, you don't have any. And I kind of cut off one of those sheets. I cut off 10 because 0 is in every single column, and we've never ever used it in an example. Okay. Part-time employees or low-income employees sometimes don't have to have their wages, federal income tax withheld, but they got to be very, very, very little amount of money. Meaning, if their income, you can't claim an exemption if your income exceeds $1,000, $1,050. Okay, and if part of that includes $350 of interest or dividends, or another person can claim them as a dependent on their tax return. Okay, so most of us, I don't know why they even put this on here. This is a new paragraph section. Most of us for our purposes, are going to be getting taxes taken out. Okay. All right. Any amount withheld from employees' gross earnings, that money that you guys just found on 12/1, any amount's going to be called the payroll deduction. All right. So what are payroll deductions? Social Security, Medicare, insurance, contributions to charities, if you're so inclined, or 401ks, Roths, IRAs, those types of things. Okay, those will all be deductions. Just depends if they're before tax or after. Usually you need to have a social security card, social security number when you're born. They give those to you. Sometimes people lose paperwork. Now if you come over from another, from not from the United States, you usually get a work visa. I'm not super involved in depth on that, but usually you get a work visa and they give you a number that will be sufficient. But social security number is usually something you'd use. So I gave you this chart. All right. And they talk about what this is. The IRS, Department of Treasury, administers tax laws. They set it up. Single taxes are different than married taxes. 3 green, use the semi-monthly withholding chart. So that's what this is. This is a single person semi-monthly payroll chart. I think it's clearer on the copy I gave you than on the computer. But you get the gist of it. And I guess the main idea, what I would tell you is, I think it's set up weird. What I mean by that is, you can see the withholding amounts are here, 0, 1, 2, 3. And as you get over here, the more withholding allowances, with the more with allowances you have, 6, 7, 8, 9, 10, the less taxes are taken out. Okay. For the same, if somebody made $1,000 in this pay period and they claim 0 allowances, they'd have to pay $105 in taxes. But if you made $1,000 and you claim 5 allowances, you would pay 0. Okay, because you have more people depending on you. But this is a single person. The part that I find interesting, why they do the way they do, I don't want to zoom out. I want to zoom in. Is this wages area? It has to be at least 1,000, but less than 1,020. Okay. So here, if it was 1,000, sometimes people go, here it is, 980 to 1,000. I got to use this number, 102. Well, no, because it has to be less than that. I've always in my entire life thought they should do 980 to 999. You know what I mean? Because you just got to be careful. If they say you have $1,000, you can't use this one, because this column is less than 1,000. This column is the $1,000. So instead of 102, you need to be using the 105 number. Does that kind of sort of make sense? You just got to be careful on that. Okay. All right. So general terms, the more withholding allowance is claimed, the less taxes that'll be taken out. If you're single, you'll have to pay more taxes usually than if you are married. Down here at the bottom of this is just all quick reminders. Federal income tax withholding column has a 0. How can you have a 0 dependents if your employee is 1? You can claim fewer than they're allowed to go as 0 to increase the tax withheld. So that guarantees you don't have to pay in March or April whenever you do your taxes. Okay. But you also might have interest and dividends, and you might have all these different things going on that can contribute to why you'd want to go to 0 dependence. But how can you get to 0? You can claim 0. You don't have to claim yourself. Okay. Here's a married person's chart. And again, I'm not going to click on this and spend a ton of time. I just want to kind of show you again, you just got to double check you ask for merit. So they have some examples here. You can see how they highlighted 4, right? And they have these charts, intersection of the earnings, locate total earnings. Okay, so if they were to ask you, this person made $1,460. you need to find it on the wages section here. Don't use this one, use the 1460 because this is less than 1460. And then if they have 4 withholdings, you would have 4. So it'd be in that column, you'd have 29 bucks of federal income tax for that pay period. That makes sense? Okay. Just double check first that you're in the correct column on the left, not the less than. Make sure you're that least column, and then where it intersects with the withholding. Often it'll be 0, 1, 2, or 3 is almost always our transactions. I gave you an example before. Again, they're just talking about it here. If this person, Mr. Butler, made 1,466.25, where would he be with the 4 withholdings? Where is it located? And that's what we talked about. All right, so I got to zoom out now. So let's talk about these taxes. Federal FICA is the Federal Insurance Contribution Act. You've heard of FICA. Takes out a lot of money for old age survivors, insurance. The Social Security tax is the federal tax paid for the old age survivors disability insurance. Medicare tax is for the hospital insurance. These are reported separately. Okay. When we take money out, when they take money out of our check for Social Security and Medicare, the employers take money out of our pay and then they have to match it and pay the government that. Okay, so which is a huge expense. Okay, employers are required to withhold and deposit the employee's tax and pay a matching amount. Thus, if the employer withholds 85 of the employee earnings, the business must also pay 85. Okay, so not only is Social Security being paid by you, the employer's matching it. That's how you can get that, so then people can pay. It's got to get. That's how you grow it. So you have Social Security and Medicare tax. We'll talk about these a little more involved, but the government matches them. They're liabilities until we pay them. They're paid by both the employee and the employer. The total gross earnings year to date for employees is called accumulated earnings. What's that mean? We said total earnings, all the money you make. So if you get paid over 12 months, you work an entire year, all your total gross earnings for the year are called your accumulated earnings. You make 2,000 this month, you make 2,000 next month, your cumulative earnings are 4,000. You keep adding the monthly totals, you keep adding to your accumulation. Okay, that's what they're getting at. The maximum amount of earnings on which a tax is collected is called a tax base. All right, so we got to think for just a minute. You're going to be taxed, Social Security or Medicare or some of these taxes based on the amount of money you make. And once you make a certain amount, they stop taxing you on. Okay. And so that tax base is the maximum amount of earnings in which a tax can be collected. When the amount of accumulated earnings equals the tax base and grows past the tax base, no additional taxes can be paid. So here's the deal. Congress sets these rules. The Social Security tax base is used as, for us right now, is going to be used as 6.2% of your earnings up to $106,800. Okay. So what does this mean? It means that our accumulative earnings from $0 to $106,800 will be taxed at 6.2% for Social Security. The minute you make a penny over that, that penny is no longer subject to tax on Social Security. Does that make sense? So they're only going to tax all the people that make up to $106,800. If you make 110, you'll pay 6.2% on your first 106,800, and every dollar after that, you don't have to pay Social Security tax. Okay. The old book, it used to say like 87,500. So I mean, these things always change. Okay. But hopefully you get the idea of tax base. You all right with that? Okay. Between January 1st and January 15th, is numbers are always, they'll say, are less than the Social Security tax base. Therefore, they're going to take all of it. Okay, so you make 1,465, you multiply by 6.2%, you get the Social Security tax for that. Medicare, on the other hand, does not have a tax base, meaning every dollar you make, no matter what, will be taxed Medicare. Medicare's tax is significantly smaller, 1.45, 0.0145 in your calculator. Okay, so your total earnings times Medicare. So you can see the Medicare tax of 21 for the same period as the Social Security is significantly less. Okay. So that's how you're going to be asked to take the total earnings times the Social Security tax rates to get the Social Security tax, total earnings times Medicare. And the number one thing you got to double check is if Social Security, if this person's total earnings come under the tax base, how much are they actually going to have to pay a Social Security? If they make over 106,800, they need to not pay any more after that. Okay, all the money up to it, yes. Okay, these are just assumptions, like I said, for these change from book to book. Okay. Last, I don't know if we'll have time to get the work together. We'll see. U.S. Congress uses tax law to motivate individuals to save for retirement. There's these qualified retirement plans. Then when you get older, so again, I was talking to my dad about this. My dad's 70, he was born in 43. So what does that make him? He'll be 78. Yes, 78 in this October. So they have mandatory money. You have to take money out of your retirement, out of your plans, a certain amount. They make you after you get over 70 or whatever. But anyway, these qualified retirement plans are just like ways to save money. And there's a variety of different ways. Okay, retirement savings plan approved by the IRS that provides individuals tax benefits. There's a variety of different ways you can take money out. So in other words, if you made $2,000 and you wanted to put $200 away, some of it can be done so that if I made $2,000 and if I wanted to save 200 of it, I could do it pre-tax. So I would take the money out, put it into a fund pre-tax. So then my tax money, then you'd start working taxes off like I made 1,800. Does that make sense? So if you make 2,000, there's some funds that will allow you to do pre-tax. So as a government employee like me, I take it out of a thing called a 503B. And that just means I take money out, and if I take it out before I make this much, I take money out, it goes down to here, then they start doing taxes. There's different funds for regular jobs, not just government jobs as well. Okay. 401k, you guys probably heard, it's qualified retirement fund. There's a plan. There's 1 million of them out there. You can go with a variety of investment people that will put them in the, wherever you'd want them to invest in, or you just follow their plans, whatever that might be. These contributions are deducted from your employee earnings, subject to federal tax, thereby reducing the amount of taxes withheld. For this reason, contributions made to 401ks are referred to as pre-tax contribution. So my 403b, 401ks, they're pre-tax. You take the money out, save it, put it in a savings account, then you get taxed. The difference is when I take that money out of my 403b later, I'm going to get taxed on it. I haven't got taxed on it before, right? So when I start taking money out, let's say I can retire in 10 years. I probably won't, but whatever. Well, if I start taking money out of that, I'm going to get taxed. Okay, that's the downfall. You take it out now before taxes, save it, it can build interest, and then you got to get taxes on. Fringe benefits of 401ks for a lot of companies, they will match your contributions, and sometimes they'll match up to a certain amount. So if you save $2,000, they'll match it, and then all of a sudden, so you'll have 4,000 for that year saved. That is a good thing. So if you could save, the more you save, You know, they might have a thing where we'll match you up to 8 grand or 5 grand or whatever the case is, but at least the company is encouraging you to be happy by saving and planning for retirement, and they're going to show you their, you know, the positive reinforcement of that by matching it up to a certain amount. Okay. But for our purposes, we understand what a qualified retirement plan is. It's a savings plan that is okayed by the IRS to help us with some, you know, saving, putting money away. A 401k is retirement plan that are done pre-tax. It's done so the money saved is not taxed. Companies can match it up to a certain amount. There's these things called IRAs, individual retirement accounts. You've probably heard of. Okay, or a Roth IRA, a Roth IRA. Okay, these are very common. Individuals, a qualified retirement plan that provides most individuals with deferred federal tax benefit. What's that mean? Okay, individuals make contributions directly to their IRA accounts. Individuals can also direct their employers to withhold contributions in theirs, but it's going to be done after taxes are taken out. So this time you get paid $2,000, you let the government do all the taxes, you have a certain amount left over, then you put it away. What's the difference? It's money that's already been taxed. So when you take it out, you don't have to get taxed on it. Different ways of looking at it, okay? Contributions to both to a Roth IRA are not deducted from total earnings and do not provide current tax benefits. However, the contribution investments to both are not subject to federal taxes when you withdraw. Does that make sense? So some 401ks, 403b, some savings, retirement, qualified retirement plans will come out before taxes, which is a good thing at that time, but then later on you'll have to pay money on them. And some like these Roths or IRAs, instead of a 401k, they'll be savings amount of money you save after you've already paid your taxes. Okay. Again, fringe benefits of these is some businesses will also deduct health insurance costs. Okay. They'll deduct, you know, some companies will have vision, some will have dental, just to kind of depends on their insurance premiums. I'm not in our teacher union, but the teacher union people told me our insurance has gone up a ton in the Urbandale Community School Districts this time through because so many teachers had so many surgeries, some huge benefit, huge medical costs. So they're going to have to change health plans. They have to raise costs on health and things. So they told us that that's going to be part of it. This little chart here shows the difference in Larry and Sandra. They both make $3,000. This is a great example of this tax stuff. Larry has medical insurance premiums of $1,500. He contributes a 401k, so that means you're going to subtract it, and then the taxable earnings for Larry is $2,600. Does that make sense? Whereas Sandra is $3,000. She doesn't have insurance taken out that's before taxes and 401k. So now you take 30% of your tax here. So 30% of 2,600 and 30% of 3,000, you can see the difference. She's paying $900 in tax. He's paying $780 because he has less money in there. So net earnings after income taxes, 1,820, 2,100. Then she pays her own medical premiums and puts the same amount of money into a Roth. But you see how it's done. Hers is done after taxes. His is done before. He will have more money in his check now, but he will have to pay taxes when he takes his money out later. That makes sense? So everybody might go, oh, this is great. You get more money. Why would you do it that way? Well, then you don't have to pay taxes later. But most of the time later means you have hopefully and more money and you're set up a little better. Okay. And so that's what they're talking about. There's a ton of different laws involved in this. We are giving you the 3-minute version of it. Okay. So we'll stop there. And what we'll do is we're gonna meet again Wednesday, right? So Wednesday, we'll do the work together on your own, then we'll do like 12-3. Okay. Sound like a plan?